Recording. All right. Now, here's the accounting cycle. So every accounting period, you go through the accounting cycle. Okay. So the accounting cycle. So what happens? The first thing you do is you have a business transaction. I'm going to make that a little higher so I can put a lot of movement underneath it. So the first thing you have is you have a business transaction. Now, a business transaction makes a difference in the accounting equation. And of course, you guys remember the accounting equation: assets equals liabilities plus owner's equity. So, in other words, if you buy something, you can sell something, you can make something, that changes the accounts. If a customer calls and says, "Do you have this?" that doesn't show, that's not a business transaction. It doesn't change the accounting equation. So, anyway, it's something that creates, that'll make a change in the accounting equation. Then, that produces a source document. And a source document is written proof of a business transaction.
Just gotta get a receipt.
I'll be with you just a second. Let me finish the transaction, right? And I'm sorry, what was that?
It's basically like a receipt.
Yeah, exactly. So what we're talking about here is we're talking about things like a receipt, a purchase order, a bank statement, a sales ticket, employee's earnings record, some written proof. Yeah.
So you know how they have those things that are like the neat desk or whatever, where you put your receipts and bills and whatever, and it transfers it onto your computer. Do you still need to keep the hard copies?
Yep. Keep the hard copy. Yeah. No. No source document. It didn't happen. Yeah. All right. Then what you do is you journalize. And what journalizing does is, and we'll get into the debits and credits later on today, is it pairs the debit with the credit and the source document. Okay, so we'll get into this. So the first thing you do is you have a business transaction, and a source document, and then you journalize. Okay, and so what the object here, right? The object here is to list the book of original entry, and what it does is it pairs the debits with the credits and the source document. Okay. Then, and we'll get into, show you how this is done, we'll get into debits and credits later today. Then what you do is you post to the ledger. Now, the ledger are all the accounts of the business. Okay. And of course, an account is it's a record. It's a record. Okay. Of increases and decreases of a specific asset, liability, or owner's equity item. All right. right, does that sound about right? Now, we'll get into these in just a minute, so let me just introduce it now. So what you do is this is where the numbers go first, right? And all you want to do is pair the debit with the credit in the source document, but then you need to start to summarize it, so you post to the ledger, and the ledger is just a collection of all the accounts of the business, okay? And they increase and decrease with each transaction. Then, what you do is you do, at the end, we do a trial balance. And the trial balance, it is a financial statement, but the thing that's different about it is its purpose is to verify the accuracy of your accounting. And it's a deceptively powerful tool, because what it does is, all it does is it verifies the debits equal to credits, right? And so it verifies that the debit equal credit. Now, but what happens here is when the debits equal the credits, right? Then you have a lot of assurances that everything was done correctly and accurately, all the addition, subtraction, recording. And if they don't equal, then you know there's an error, and now find it, okay? And so then the next thing you do, of course, is you produce the financial statements. And those are, of course, used to make decisions. Okay, and so every accounting period, we go through this. And so, okay, and so then you have the ledger, you got the trial balance, you got the financial statements, and then you use them. The purpose of this whole thing is so you can make decisions. Okay? So, what we're going to do today is we'll get into the debits and credits. We'll possibly into some journalizing. Next Thursday, we'll get into the ledger. We'll probably cover the trial balance today. We've already done the financial statements. Okay? All right. Questions, comments before we move on? All right. So let's do this then. Let's get into the accounts. So let's start with an asset. So some of those with an asset, there's land, and there's building. Now, normally when you buy a building, it comes with the land, right? But you need to put them in separate accounts because they depreciate differently. So a building, land never depreciates, it doesn't wear out. A building does wear out. So they got to be in two different accounts because there's just two different depreciation schedules. Equipment is another example. Okay, and equipment is generally by purpose. So you have store equipment, office equipment, shop equipment, but it's by purpose is how generally they're categorized. And what I'm doing now is I'm going over back here. We talked about the ledger consisting of the accounts and their records of increases and decreases in specific asset, liability, or owner's equity. So this is we're going over accounts. We're starting with asset, and this is what we mean by an account. Okay, and they'll increase and decrease as you do business. Okay? Supplies. Now the thing about supplies is, because supplies are used up so quickly, what most businesses, or many businesses do, is they just expense them when you purchase them, right? Now, what we're going to do in here is we're going to follow GAAP a little more closely, is you're going to register them as an asset when you buy them, and then the amount you then expense them as you use them, okay? But don't be surprised in the job to see it expensed right away, okay? There's accounts receivable. And of course, accounts receivable, this is where you performed a service, you sent a bill, you're waiting for your money. Okay? All right? Now, there's also a note receivable. Okay? And in a note receivable, what you have here is these are, both of these are assets, right? But a note receivable is an on-condition promise to pay. So what happens here is one of your accounts receivable gives you a call and says, I can't pay. I want to pay up, I can't pay it right now. Can I have a little time? So you say, yes. However, I'd like to change the accounts receivable to a note receivable. And the reason you do that is because a note receivable is an unconditional promise to pay. So it's just easier to collect and harder to get out of. So the accounts receivable is certainly collectible, but the guy can say, I didn't receive the goods, they were damaged, whatever, right? When the person signs the note, that's awful hard to get out of. It's an unconditional promise to pay, so it's easier to collect, okay? And then there's prepaid accounts. And I'll just include this over here. There's prepaid. Okay. And I'll just call it accounts. And so what happens here with a prepaid is, insurance is an example of this. So if you buy, when you buy an insurance policy, right? What it is it goes under prepaid insurance. It's a prepaid expense. So let's say you paid $1,200 for your year's policy. Well, there's 12 months to a year, right? So 12 into 1,200 was 100. So every month passes. When you buy it, it's an asset. And every time a month passes, $100 has expired, $100 is used up. That $100 was the cost of business or an expense for that month. And so you lessen the asset. Now it's down to $1,100, and it shows up as an expense. But insurance is an example of a prepaid account, prepaid insurance. Yeah.
It's also, like, if you pay month to month, instead of having to be pulled out of an account.
That's
the same
different.
thing.
This is where you, and of course, most of it, yeah, that's just different.
Yeah.
Another example, you know when you rent, often you have to pay the first and the last month, right? So if you're a business, the first month shows up as rent expense for this month. The last month is an asset, that's a prepaid account. And it resides in your books until you get the last month and you use it up there. So that would be an example, of prepaid rent, the first and last month, that'd be the last month. All right, let's get into liability accounts. And of course, a liability is the business's debt, okay? Now, we have accounts payable. And accounts payable, of course, now this is often a supplier, it's 30 days, it's short term. So the supplier delivers goods and you pay this person in 30 days, okay? There's also a notes payable. And of course, just as with a notes receivable, what happens on this thing is you call up your supplier and say, listen, I'm a little short of money, can you give me an extension? And your supplier says, yes. But I'd like you to sign a note payable, okay? And for the very same reasons that you did with your customers, okay? You have unearned revenue. Now, unearned revenue is a liability, and it's so what it is what we're talking about with unearned revenue is we're talking about some sort of a prepayment, okay? Some sort of an advance payment. So, suppose you publish magazines. Your customers normally pay, buy a year's subscription. So when you get that money for a year's subscription, that is liability from your standpoint. Okay, in other words, it's really not your money, right? At that point in time, you got to deliver the goods, deliver the services, or refund the money. So when you receive a prepayment, like when your customers subscribe early, then that comes across, that'll be a liability. But it's a prepayment that you earn. So it's, and of course the name is good, it's unearned revenue. So when the bank publisher then delivers the magazine, that's earned. But it's unearned when it's received, okay? And then there's accrued liabilities. So what happens here is, one example of this thing is you owe taxes. Taxes accrue as you make money, right? And so then you keep track of them as they go along, and then you pay them when they're due. But until you pay them, you owe them, and you'll pay them when they're due, but as they accrue, as they incur them, that's an accrued liability. It's an example of one. Okay? So then we have the equity accounts. And there's not much we need to add to them. So for the equity accounts, what we have, of course, is we have owner's capital. And owner's capital, of course, is where you put an investment. You have owner's withdrawals. And owner's withdrawals is where the owner takes capital out of the business. You have revenue, which is money you earn. And you have expenses, which is the cost of doing business or expenses generate revenue. Okay? Does that sound about right? Those are owner's equity accounts. All right, you guys doing good? All right, so let's just have a quick review of what we're talking about here, and then, well, I don't know if you need a review. Let's go ahead and do this. So we're going to start working with these accounts, assets, liabilities, owner's equity, and we're going to start working in terms of debits and credits. That's where we're headed next. I'm going to turn that camera around. Make sure I don't brush anything off here. And let's go ahead and get into debits and credits. Okay? So, here's what happens is, let's see. This won't be able to get. All right. So, debit, credit. Now, debit means one thing. It means left. And credit means right. Okay? Just like when you're on a ship, you have other names for right and left. Left is port, right is starboard, right? If you were in Alaska and you're driving a dog team, you'd yell G, they turn right, you yell ha, they turn left. Okay? So, and that's all that it means. Here's a T account. On the left-hand side is the debits, and on the right-hand side are the credits. Okay? And all it means is left and right, nothing more. Okay? Now, double entry bookkeeping means that there'll be always at least one debit and credit, okay? And the debits will always equal the credits, okay? So, you guys doing good? All right. So let's kind of set up the system here, and let me show you how this works. Okay? So, here we have assets. And then we have liability. And we have owner's equity. Now, under owner's equity, all right, so let's stop here. So, I'm going to put a T account under each one. Now, by the way, under owner's equity, we also have withdrawals. And here's the T account for that. We have revenue. Here's the T account for that. And we have expense. And here's the T account for that. Now, the left will always be a debit. Okay? The right will always be what?
Credit.
Credit, sure. Okay, now, I've never done it, because I didn't think anybody would take me seriously, but what I've heard people do, and they rave about it, claim it really works, is you ask everybody to get up and form a circle around the classroom. And you ask them to step off with their right foot and say, credit, debit, credit, debit. And they swear, it just, everybody knows it by the time they make one circle of the room. I think I'll pass, okay? All right. But here's how it works. Assets increase with the debit, okay? Now, assets increase the debit. When you cross the equal sign, it reverses. Liabilities increase with a credit. Owner's equity increases with a credit, okay? Now, withdrawals, what do they do to owner's equity? They decrease it. So if they decrease it, they'll always be debits. Okay? Revenue always increases owner's equity, so it will always be a credit. Expenses always decrease owner's equity, so they're always a debit. So, here's the way this works, is assets now decrease with a credit, liabilities decrease with a debit, the opposite, and owner's equity decreases with a debit. Okay? Now, let's go ahead and plug in some numbers here so you see how this thing works. Okay? So, let's say this is a window washing business. Let's say the owner, now under assets, we have the account cash. Here's the T account. We have supplies. We have accounts receivable. We have supplies. We have prepaid insurance. Okay. Under liabilities, we have two accounts. We have accounts payable, and I'm going to write A/P, just like A/R was accounts receivable, right? A/P, and it just moves along. And we also have unearned revenue. Okay, we have the capital account here. We'll have the withdrawal here. We'll have revenue here. I'm going to get a new marker. And we have expense here. Okay? Now, I'm going to take just a second and get a darker marker that's been lightened up too much. Now, the owner starts the business by investing $10,000 in cash. So I'm going to put $10,000 on the debit side of cash, and I'm going to put $10,000 on the credit side of the capital account. Okay? So, and again, don't forget, assets increase with the debit, that's why I debited this. And owner's equity increases with a credit, that's why I credited this. Double entry bookkeeping, there's at least one debit and at least one credit, and the debit's equal to credits. Okay? Now, they supply, what they do is they buy $500 worth of supplies on credit. So accounts receivable is an asset account. It increases, it'll increase with a debit. Okay?
Wait, if they purchased it, why is it accounts receivable? Shouldn't it be accounts payable?
Oh, I'm sorry, it goes under supplies. Darn it, anyway, no, I've got to quit, that's okay. Now, by the way, I got to talking and thinking, right? Now, but it's okay to make an error like that, because everybody perked up, and if there's one thing you remember from today's class, it'll be that, all right. So listen, I'm gonna put it under supplies, and, so it'll be a debit to supplies, right? Where's the credit go? Accounts payable. Okay, and you credit accounts payable, right? One debit, one credit, right? Debits equal to credits? Okay, now, what they did is they washed a bunch of windows, and the customer paid them $1,000. Okay, there's going to be two entries. What are the entries?
Accounts receivable.
You know, the customer paid them
Cash.
revenue and cash. So, am I going to debit cash? Yes. Okay, and I debited cash because the asset increased. And I'm going over here revenue, and I'm going to credit here, and we're going to call it window washing revenue. Okay? All right. Now, I pay the rent of $600. Okay? So there's going to be, I pay the rent of $600. So this will be rent expense, will be the name of this account. Now, I'm going to pay the rent. That means cash goes down, right? When an asset goes down, do I debit or credit it? Credit it. So I'm going to credit this with $600. And then expenses will always be debits, and the reason they'll always be debits is because what they do is they decrease owner's equity. I put the plus sign here because the accounts will increase with a debit. And then you end up subtracting the total. The account will increase with a credit, right? It will increase with a debit. However, then you take the total and subtract the total. Revenue works the same. It will always increase with a credit, and then you add the total. Withdrawals will always increase with a debit, and then you subtract the total. Okay? All right. Okay. Now, let's see, we paid the rent. Now, we wash more windows. Let's make it for $700, a different number so it's easy to see. And we send the customer a bill. We're waiting for our money. Okay? What assets affected? Accounts receivable. Increase, decrease. Increase. When an asset increases, is it a debit or credit? Debit.
Debit.
Right? So we put $700 here. And where's the other $700 go?
Revenue.
Revenue. And of course, when revenue will always be a credit, because what it does is it increases owner's equity. Okay? Now, the customer pays us, and the $700 shows up in our mailbox, right? Okay, perfect. So accounts receivable is a credit because it goes down as a zero balance. So if the credit goes here, where's the debit go?
Cash.
Cash, sure. And by the way, guys, don't forget there'll always be a debit and a credit. So if you know one's a debit, the other will be a credit and vice versa. Okay? All right? All right. And of course, what happens is here, the equation will always equal. In this case, they're on the same side of the equation, so the debit and the credit will cancel each other out. Okay? All right. Now we're going to pay this accounts payable, so we're going to send a check to the supplier for $500.
Credit on cash.
Exactly, $500 credit to cash because the cash is an asset. Assets go down with the credit. And then what do we do with accounts payable?
Debit.
Debit. So liabilities go down with the debit. Now this liability has a zero balance, but the liability goes down with the debit. Okay? All right. The owner takes $20 out of the till to go to lunch, right?
So under assets to $20 credit
For what?
for cash.
Right, exactly, $20 credit for cash. Where's the debit? Withdrawal. Okay, everybody good with that? All right. Now, this office building contacts you and says, listen, I'd like my windows washed every month. And so what I do is if you give me a discount, right? So it's $100 a month, but what will happen on this thing is, rather than pay $100 a month, if I do a contract with you, pay you in advance, will you give it to me for $50, right? So what it means is you get a check for $600 and agree to wash this person's window, wash this building's windows every month. Okay, what kind of so when you receive the cash, what do you do with the cash?
You debit.
Debit, sure. So you receive the $600,
And that's the pre.
and then where's the credit go?
Unearned revenue.
Unearned revenue. So at this point in time, the business has the cash, right? And the business has a liability. Because at this point in time, it's not really their money, they've acquired debt, yeah.
So would each month, would that?
Exactly. So here, sure, so so 1 month happens, they wash the windows. So now what happens on this thing is, this goes down by $50, leaving $550 as a balance.
And then
And it goes over here
it
under,
all goes in the revenue.
exactly. So when they earn it, so when you receive the money, it's debt.
So but you don't decrease the, oh, because you took that off the get-go.
Cash didn't change.
Okay.
They paid you one time and they paid you the $600. They paid you the $600, okay? They paid you the $600. Now that doesn't change. What does change is your debt goes down because you don't owe it, and your revenue goes up because you earned it.
Okay.
Okay? Now, by the way, so often people think there should be some sort of a revenue entry, but all you did was earn, some sort of a, no, I'm thinking of something else, never mind. Okay, okay, that'll do it. All right, now, what it is you pay $1,200 for a year's worth of insurance. Okay, what happens with cash?
Credit.
Exactly, because it goes down, the asset goes down. Cash is an asset, goes down to the credit, okay? Where's the debit go?
Prepaid.
Prepaid insurance, okay? So this asset goes up with the debit, this asset goes down with the credit. Okay? And to kind of follow up on that, 1 month passes, 1/12 expires, so what you do with that is you credit this with $100 that's expired, there's $1,100 left, and that $100 will go over here under insurance expense. Okay? To kind of follow up on what you're talking about for, yeah.
So unless it's a prepaid insurance thing, should it usually be on either side of the equal sign, like assets, and then, you know, the...
Oh, it kind of works, no, the value equation will always balance. So it's kind of the same thing. So if they're on opposite sides of the equation, right, the one will be a debit and the other will be a credit. If they're on the same, they'll always be, if they're on the same side, there'll also be a debit and a credit. Okay? I think that what you're trying to say is, don't forget, when they're on the same side of the equation, the equation was still equal, because like an asset. So, like for instance, when we receive, do you mind if I put that there? Sure. So for instance, when we received the money for this accounts receivable, right? Then accounts receivable went down, cash went up. The equation still equals because they balance each other out, I think is what you're kind of getting at there. Okay, and if they're on opposite sides of the equation, here the debit will increase it, here the credit will increase it, both increases so they balance. And I think that's what you're kind of alluding to. So just as before, the equation always, so there's a bunch of equals in here. So the equation always balances, and the total debits equal the total credits. Is the way that, and that's what's called balancing the accounts, when they do equal. And this is kind of moving ahead. The purpose behind that is when they equal, then you have a lot of assurances that everything was done correctly. And if they don't equal, you know there's an error. And that's why you do the double entry, double entry. So for instance, your checkbook is a single entry bookkeeping system, right? You just write one. And the only way you know it's accurate is you re-add the numbers. With a double entry bookkeeping system, which is a lot more complex, you do a trial balance, verifying the debits equal to credits, and when they do balance, it's much more powerful than you think. It'll catch maybe 90–95% of the errors a person can make, won't catch all of them. And with that assurance, you can then do the financial statements, feeling assured that they're correct. And if it doesn't balance, then you know there's an error. Just look for it before you produce your financial statement.
My question was
Okay.
kind of more like if assets is going to decrease,
Okay.
is liability going to increase? Like, does it always have to be like that? But you answered that kind of when you said
Okay.
accounts receivable.
Well, it just, first of all, the always doesn't fit. Everything else you said is true, but the always, right?
Yeah.
The always doesn't fit. So let's take this one. So what we did here is here we have the liability accounts payable. And so when we paid the $500, there was a $500 credit here, there was a $500 debit here. In this case, both decreased, and it continues to balance. When they made an investment, it was the opposite scheme of things in that, well, let's stick with the accounts payable. When you got the supplies, there's a debit here and a credit there. They both went up. Okay. How's everybody else doing? All right. Now, let's do this. We did, and normally, okay, so let's do some practice here. And what I'd like to do is, okay, and let's do some practice so we get this down. Now, all right, so let's start with exercise 2A, and this really works better if you guys have a chance to talk things through. So, and I'm just going to ask people sitting next to each other to be a team. You guys want to be a team? All right, there you are. You guys want to be a team? Here you go. I'll put it there for you. Okay. All right. You guys want to be a team? There you go. Okay. Like to be a team? Okay. You guys want to be a team? Put that there for you. Like to be a team? There you are. All right. You guys want to be a team? Okay, sure. All right. You guys want to be a team? Okay. All right, let's take a look here. You guys want to be a team? What's that? All right, now let's take a look here. You guys want to be a team? You like to? Okay. Let's take a look here. Now, what do you say? You guys want to be a team? Would you feel okay about turning around and being a team of these two? Or how do you guys want to do it? All right? And you guys want to put together and be a So yeah, just want to make sure you break it up. All right. Okay. All right. So this is exercise 2-8. Yeah. Is that what it, it is? All right. So it's exercise 2-8. You find that on page 79. Now I'm going to turn out. All right. Okay. Let me turn out the lights so it's more readable. You do this. This. That's too dark, isn't it? Let me do this. Is that still too dark? Yeah. All right. Let me do this then. All right. Let's see. Okay. All right. So, here's how it reads. Okay, so. Okay, so here's the problem. Here's the challenge. Let's not call it a problem. So it's exercise 2.7 and again 2.8. And again, don't forget you guys, when there are odd numbered pages, you gotta look to the right. So let me open it up. So here's how it reads. What it says, the bottom 2.8 is the one on the bottom. I'm waiting for the autofocus to get off there so it doesn't focus on my finger. So here's 2.8. All right, how you guys doing back there? Let me, hey guys, here you go, thanks. Hey listen, here you go, here's 2.8. Now what it says is use the information from 2.7, that's this one here. And what they want you to do is, we'll do the trial balance later, okay? But what they want you to do is they want you to enter these into the T accounts. So, and here's the T accounts. We have cash, office supplies, prepaid insurance, and photography equipment. Those are all assets. K Madison Capital, photography fees. Now, and by the way, you guys give me your attention, I'll walk you through some things here. So, fees. You know, you and I, what can kind of cause confusion here. Let me have everybody's attention here. All right, I hear. You guys give me have your attention? Okay. Fees are something you and I pay. So often you think fees are an expense. Well, the business charges the fees. So when it says fees, normally that'll be a revenue account. And of course this says fees earned. When it's used the word earned, you know it's a revenue. Okay? And then there's one expense. So the first one then says K. Madison, the owner, invested $7,500 cash. So here's the cash account. And you guys, can I have your attention on this thing? Thank you so much. So let's do this. So what we have is we have the cash account. So this is August 1. We'll have a $7,500 debit to cash. Photography equipment, here's August 1. There'll be a $32,500 debit to photography equipment. All right, we add those two together. These are debits, add those two together. That'd be 9, 10, what's that? Let's see, that'd be 32, 40,000. Credit to. Is everybody okay with that? Let me turn you loose. Now, by the way, we'll do the trial balance later, probably on Thursday. Right now, let's do this one. Okay, is everybody okay with that? Now, and by the way, I'll leave this up here on the board, but don't forget, there's also an example on page 56. So there's also an example on page 56. Okay? And I'll put the answers of the questions.
So next one,
the credit. Yeah.
credit, yeah.
Now, who needs to sign the roll? All right. Okay. You did, all right. Here you are. There you go. When you're done, can you hit this guy that's right here? Yes. All right.
Credit, debit.
Cash equals. I kind of saw it, so I put it on myself this moment, just because this person I got it, and on myself.
Wait, it's a red, yeah, so it's a red.
But it's just practice.
And it's not difficult, but it's kind of, you just do it. You can make pictures.
As long as you're putting it.
Yeah, it's not a math course. No. And in fact, some reason
Part of the
somebody else back there. All right, everybody got the roll? I think they're open now. I think if they're not, I think they should be. All right, you guys ready with some answers? All right, how's this? Let me give you a chance to look this over, and then I'll see if there's any questions. Oh, no problem. What do you got in the way with you?
Oh, I was just gonna say, when you're handwriting, or writing the dates on the insides, are you supposed to, should you write dates always on the left?
Listen, that's an excellent question, because what you're talking about is a convention. A county has conventions. Now, this incidentally is just portraying it graphically. This is not something they use in a real setting, so there aren't any conventions for this per se. Okay. Now, later on, we'll do that German forum, and there's very strict conventions. Excellent question. But later on, there are conventions, and the deal is this great to your advantage, because when they call a convention, like everybody calls the same convention, you can go anywhere in the U.S. and know what an income statement says, because they're all the same conventions or whatever. But yeah, this one. Hey, you guys, what questions are there? Anything?
Yeah.
Yeah.
Okay, so we were wondering, we put photography fees earned at $26.50. We put it on the debit side, so that was partially stabbed in the dark. Partially, we thought, you know, it was earned, so it went into debit.
Well, now don't forget, and by the way, can I have everybody's attention here, and I'll walk you through these things?